Hello, everyone. Just wanted to come and talk with you a little bit about two of the main ideas I think from chapter one. Now, one of the main ideas from chapter one, I think, is learning a little bit about the technology or the terminology that's related to accounting, and kind of introducing you, talking a little bit about accounting organizations and that terminology. So I think that's a big part of it because a lot of that terminology you're going to see over and over as we go through the course. So it's a good idea to kind of make sure that you understand that terminology. But I think the two main things are one, understanding the accounting equation, which is going to be something that you're going to look at all through the course. And another one, which might be the most important thing, is understanding the basic financial statements. And all through the course, we're going to kind of examine the financial statements and parts of the financial statements. I mean, so we're kind of laying a little bit of a foundation that we're really going to build on, especially in chapters two and three, um, that we're going to use throughout the course. So these first three chapters are very important. So in this video, I'm going to talk a little bit about the accounting equation. So I'm going to go ahead and share the screen and open it up. Okay, so I have the accounting equation right here in front of me. This is a little bit more expanded version. Um, but basically, the emphasis or the main thing with the accounting equation is that a company's assets equals their liabilities plus their equity. Now, assets are the things of value that a company owns. So, assets would be the cars and the land and the buildings, cash that they have. Anything of value that a company owns is going to be their assets. Now, their liabilities are going to be their outside debts. You know, it's going to be the money that they owe on their mortgage or different debts that they have. And then equity is going to be the owner's investment of the business. If that's a corporation, that's going to be the stockholders. If it is like a partnership, that's going to be the different partners that are involved. Now, equity also includes, as we'll talk about later, basically retained earnings, which are the earnings that are reinvested back into the business. So you can kind of think of it this way. The things of value that a business owns are either paid for through outside debts or the investment of the owners. The things of value that a company owns, the assets, are either paid for through outside debts, liabilities, or the investment of the owners, which is equity. And equity consists of money that's been contributed by the owners, or equity consists of retained earnings, which are earnings that have been reinvested back into the business. So this is a pretty important thing to kind of keep in mind. And what you'll see is as we go through the course, as transactions occur, the accounting equation should always remain in balance. The accounting equation should always remain in balance. Now, couple of other things I kind of wanted to mention real quick here is of all of these different, assets and liabilities and equity, there's going to be transactions that take place, and transactions are recorded to accounts. And accounts are basically named after whatever they represent. So if an account represents the amount of cash that the company has, that's going to be their cash account. If it represents how much revenue they're earning from business deals, then that's going to be their revenue account. So accounts are basically set up and they're named after what they represent. So always kind of keep that in mind. Um, Also here, kind of keep in mind that assets and liabilities are basically kind of in unto themselves. Now, again, there will be different accounts like cash or accounts receivable, which we'll talk about in a moment, that are assets, or liabilities such as accounts payable, which we'll talk about in just a moment. But notice that under equity, you do have a couple of different elements to equity. One is contributed capital, which contributed capital basically would be the common stock. If you're, and most of this we're talking about from the aspect of this being a corporation, corporate, following the corporate form of business. Now, a corporation can issue stock in order to bring in funds to reinvest back in their business, or excuse me, to invest in their business. And most corporations do. Now, also there, a corporation can bring in funds through retained earnings. And retained earnings would be basically this part of it. This would be basically the revenues and the expenses and the dividends. What retained earnings are is these are earnings that have been reinvested back in the business. The company has decided that we're going to put these funds back into the business. We're not going to share them with our investors. We're going to reinvest them back into the business. Now, so basically under contributed capital, you're going to see common stock. So common stock is going to be the main account there. And you see here, I went ahead and set up a few accounts. So in a moment, when we look at a few transactions, we're kind of moving forward, or just kind of moving that direction. Now, notice that under retained earnings, we've got revenue. Now, revenue is basically whatever a company earns from doing what they do as a business. So revenues for Walmart would be items that they sell in their store. If I had a lawn care service, my revenues would be, what I get whenever I mow your lawn. Or so for different businesses, their revenues really just consist of whatever they do to, as part of their business, to bring in funds to whatever they do as a business. I think probably is the best way to think about it. Expenses are the cost of doing business. Expenses are going to be like what they pay their employees, which you see here is salaries expense. Expenses might be rent, they might be utilities. So expenses are basically what does it cost a company, or what's the cost of doing business. Now, dividends are a little bit different. What dividends are is dividends are whenever a corporation decides to share some of their profit with their stockholders. So if a corporation makes money, they've got greater revenues than expenses, then they might decide to pay some of that out in the form of dividends to their owners, as a reward to their owners for investing in the business. And that's what dividends are. So basically this equation should always be in balance. The assets should always equal the liabilities plus the equity. And basically, as we look at a lot of different business transactions in this course, this accounting equation should always be in balance. Now, let's look at a few transactions, and you'll kind of be able to see what I'm saying. So let's say we were to start a new corporation, and we issue stock for cash. So basically, let's say that we get in $100,000. Let me do it this way. Let's say that we get in $100,000. So we're going to get in cash. And then the offset to that is going to be common stock. So one of the things you're going to see with the different transactions that we look at is that there has to be something monetary with the transaction. And also that there's always at least two parts to a transaction. So if we issue stock for cash, there's the two parts are we've issued stock and we've received cash. So for every transaction we're looking at, there's going to be two parts to it. Let's say that we purchase some equipment for cash. So I don't have an account set up here for equipment. I'm just looking at a few basic transactions. So let's say that we set up an account here for equipment. If I go ahead and just I had a few accounts set up here, but I decided to include this one. This would be a good one to include. So let's say that we purchased $25,000 worth of equipment. So I'm going to get equipment for 25,000, and then I'm going to take it out of cash. So now basically after this transaction right here, I now have 75,000 in cash. Now, notice that after those two transactions, after the company getting cash for issuing stock and then using cash to buy equipment, notice that the accounting equation is still in balance. Notice that we have 100,000 on the asset side, and notice that we have 100,000 on the liabilities plus equity side. So always keep in mind that after your transactions, after every transaction, the accounting equation still should be in balance. And you'll find that this is really one of the fundamental aspects of accounting. This is kind of a real foundation building step here. Now, let's say that we want to get, let's say we want to get some office supplies. And office supplies, of course, would be just supplies that we generally use around our office. So let's say that we get, and I'm kind of just moving down kind of each step along the way. Um, let's say that we get $1,000 worth. Let me do something here too. I'm noticing that I'm going to need to add some rows here. Because we're doing a little bit more than I think I noticed that there were some lines there for that I was going to use in the next session. We're talking a little bit about the financial statement. So let me add a few more rows here. Okay. So let's go down here. So let's say that we get some office supplies. So I'm going to go right here and I'm going to say, let's say we get $2,000 worth of office supplies. And let's say that we decide to do it on account or on credit. Then we would have 2,000 here in accounts payable. Now, remember that every account is named by what it represents. So if we buy office supplies, that's going to go into the office supplies account or going to be recorded there. If we do it on credit, the typical account that companies use is accounts payable. What accounts payable represents is short-term credit arrangements where a company gets the product or they have a service performed for them, they're billed and then they pay for that within 30, 60, or no more than 90 days. There's not any interest involved with accounts payable. This is an arrangement that many companies have set up with companies that they normally do business with. So accounts payable is a pretty common account you're going to see. For example, a lot of companies have an account with Staples. So they need office supplies. They order them from Staples, put it on their Staples charge. They get the office supplies. Staples will bill them. Then they'll pay Staples. But again, that's a creditor. That's basically a short-term credit arrangement. So in this case, office supplies would be increased, and so would basically accounts payable. Now, one of the things I did want to mention real quick is remember when we did the transaction where we purchased the equipment with cash? A lot of the transactions you're going to see are going to be simply trading one asset for another. And in this case, we just simply traded cash. We reduced cash. We took it out of our cash balance and used it to purchase equipment. So a lot of transactions are simply trading one asset for another. So that's a pretty common transaction that you're going to see. Now, let's actually earn a little bit of revenue. Let's actually do a transaction or look at a transaction that basically where we're actually doing something that we normally do as a business. So let's say that we perform a service for $5,000, and let's say that we get paid cash. So we would come over here, we're paid cash. We would then basically now have what, $80,000 in cash. We had 75, we added 5, so now we've got 80. So the transaction was, we recorded the revenue that we earned, and we recorded the fact that we were paid for that. And again, notice how every transaction has at least two parts for it, or affects at least two different accounts. That's what you're going to see in accounting. So think about it. We're looking at transactions. We're recording them where they should go, the accounts where they should be recorded to, where it belongs within the accounting equation, and making sure that the accounting equation is in balance. So let's make sure it is. We got 80, we got 25, so that's what, 105, and 2, we've got 107 on the asset side. And we come over to the liability plus equity side. We've got 2 plus 100 plus 5. We've got 107 on this side as well. So basically, we are all in balance. We are doing good. That's a good thing. And so we come down here and let's get paid again. So let's earn another revenue. So let's say that we do a job for we complete a job for $3,000. So now we've earned what, let's say 8,000 in revenues. And let's say this time though, it's on account, or on accounts receivable. Now, what accounts receivable represent is anytime that we allow a customer to pay us at a little bit later date, we record that as accounts receivable. So let's say that we're a service company. Of course, we have service revenue, so we're a service company. And we perform a service for a customer. And that customer agrees to pay us 30 days later. So we bill them, we go ahead and record the transaction, we record the revenue, and then we set it up as accounts receivable because that's money that the customer is going to pay us eventually. So accounts receivable is kind of like us granting short-term credit to our customers. We finish a job, we make a sale, they agree to pay us 30 days later, we bill them, we record the transaction between accounts receivable and the revenue, and then eventually they pay us. So basically a lot of companies have a setup like this, where they allow or give their credit, or their customers, kind of a short-term credit. They perform the service, they give them the product, they bill them, the customer pays them like 30, 60 days later. So accounts receivable is kind of granting short-term credit to your customers. A lot of companies do it and use it. Let's go ahead and pay our employees. Let's go ahead and pay an expense. So let's say that we're going to pay our employees, and it's going to be under salaries expense. Let's say we're going to pay them, let's say $2,000. And so that's basically going to come out of cash. So we're going to reduce cash by it. Typically, whenever, especially here at the first of the class, typically whenever you see an expense, you're going to be paying a bill. You're going to be paying your rent. You're going to be paying your employees. There are sometimes things later that we're going to look at which kind of build on that a little bit. But for now, typically at this point in the course, whenever you see an expense, you're typically paying a bill. Think of it that way. Because remember, expenses are the cost of doing business. What you're paying your employees, it's what you're paying for utilities, it's what you're paying for rent. The cost of doing business. So what that does to our cash balance now is that gives us what, 78,000 in cash. So let's make sure the equation is in balance. So we got 78 plus 3, that's what, 81, plus 25, that's 106, plus 2, that's 108. We come over to this side of the equation. We've got what, 102, we've got 110, and Notice that there's a minus here, which means that expenses and revenues are going to be deducted from the balance in equity. So this basically then counts as a minus, so -2. So we've got 108 on this side as well. So 108 on the asset side and 108 on the liability and equity side. Because notice the little marks here. We've got liabilities plus common stock plus revenues minus expenses and minus dividends. So expenses and dividends reduce the balance on the liability and equity side based on the accounting equation. Let's pay a dividend. Let's say we pay a dividend in the amount of $2,000, or let's say $1,000. So we're going to pay the dividend, and that is also going to come out of cash. A lot of your transactions involve cash. We're paying something or we're receiving something. So cash is a pretty common account that you're going to see. So now we have what, 77,000 in cash. And let's see if we're in balance. 77 plus 3 is 80, 105, 107. And then we'd have what, 102, 110. And then notice again the minus for expenses and dividends. So this would be 108 and this would be 107. So we've got 107 on each side, and the accounting equation is in balance. And remember, the accounting equation should always be in balance. So basically, that's what I wanted to talk about as far as the accounting equation, and to kind of familiarize yourself with it. And have a great day.